Okay, class, let's start. For inventories in your handouts, we will be starting with number 20. So number 20, Jonestown Company operates in an inflationary environment and sells luxury cars. Jonestown intends to decrease its tax burden by using LIFO for its inventory pricing method, under which of the following circumstances would the tax reducing implications of LIFO be mitigated? Go over the choices. Letter A, the products Jonestown sells are generally unaffected by inflationary pressure. Number two, Jonestown indexes its prices to inflation. Jonestown's competitors use specific identification. Letter D, the weighted average cost method produces costs that are typically 70% of the LIFO costs. The best answer here, class, would be letter A. If you are engaged in luxury cars, you are not going to be affected. Generally, you will generally be not affected by inflation because your prices will ordinarily be just the same whether you use FIFO or LIFO, since in the first place the demand for your product is not driven by price because again you are dealing with luxury items. The answer here would be letter A. Definitely, if you're engaged in luxury items, the prices will not be indexed to inflation rates or inflation levels. Next, number 21, the management accountant of Clifford Products has decided to value inventory using last in, first out. Because for some reason, there will be a lot of questions on last in, first out, even though we know that last in, first out is not allowed. Okay, but for some reason, they would want to test you on the effect of using an accounting policy that is not even allowed to reduce its tax expense. Under which of the following situations can a decision of the management accountant go wrong? So the accountant suggested to use last in, first out. So your ending inventory would mostly be from the old stocks, while your cost of goods sold would go to your would come from stocks that came in last. The answer here would be letter B, when the prices are rising and inventory quantities on hand are decreasing. Okay, so if you want to reduce your tax expense, basically you want your income to go down because tax expense is based on your taxable income. So in letter B, when the prices are rising and inventory quantities on hand are decreasing. When the prices are rising, meaning the most recently purchased items are priced higher. And as what we mentioned earlier under last in, first out, those that are purchased last will form part of your cost of goods sold. Again, in LIFO, your cost of goods sold would primarily be coming from items that are purchased last. And if these items are expensive because prices are increasing or are rising, that means your cost of goods sold would be high. And if your cost of goods sold would be high, what would be the effect on your net income? If cost of goods sold is high, what is the effect on gross profit and net income? Gross profit and net income would go down. And if net income would go down, what will happen to your tax expense? It would also go down. Okay, next, number 22. Sandra, a financial analyst, is analyzing inventory of companies from four different industries: consumer goods, sports goods, electronics, and aircraft manufacturers. Assuming that the inventory valuation methods reflect the actual flow of inventory and the inventory includes finished goods only, which of the following industries will most likely have similar costs under both first in and first out and last in and first out? So you have to choose among the four. Consumer goods, what's the behavior class or the nature of consumer goods? In terms of quantity, it would be large. Okay, but the prices compared to the other items class would be lower. And then basically the in the choices class, these are arranged from those that are normally cheaper in price down to the most expensive. And in terms of volume, uh, you would expect volume for consumer goods would be higher compared to the other choices, especially for your aircraft manufacturers. But the main distinction here is that for consumer goods class and electronics and sports goods, mostly the products are homogeneous. When we say the products are homogeneous, meaning they are just the same, they can be mass produced. Unlike your aircraft manufacturers, they are rarely mass produced, so they could be even customized. So the best answer in number 22 would be letter D. Okay, the industry for aircraft manufacturers deal with high value and customized orders. So the production usually starts after the order is received. Since there will not be any equipment that will remain in inventory, since you will only work on it if there's an order, the inventory balance will normally be zero, regardless of the valuation that would be used. Okay, so there will be very little differences under the first in and first out and last in and first out. But of course, if you compare these to products that are mass produced, that are produced and sold in huge quantities, then definitely there will be beginning inventories and ending inventories. And if there will be beginning and ending inventories, you can expect that there will be a significant difference when you use first in and first out and last in and first out. So again, the answer number 22 is delta. Number 23, please try to solve, class. The question in number 23 is, what amount should the company report as cost of goods sold? And I think we discussed the computation of cost of goods sold in our discussion on income statement. You begin with sales, you deduct cost of goods. In our income statement, we begin with sales, we deduct our cost of goods sold to arrive at our gross profit. And then we deduct our operating expenses to arrive at our net income. And I think we discussed computation of cost of goods sold also or not. Anyways, when we compute for cost of goods sold, we begin with uh, beginning inventory. And since this is just a merchandising company class, so the computation of cost of goods sold would be simpler. So we begin with beginning inventory, and then what do we add? We add your purchases. That if you add those two, you would get your for merchandising. That will already be your goods available for sale. If you deduct the ending inventory, then that's when you get the uh, cost of goods sold. But what makes problem number 23 peculiar is that you will have to use the average pricing method. So first, determine first how many units were sold. Given how many units were sold? 10,000 units. So if we were using first in and first out class, if we were using first in and first out, the 10,000 units that were sold would generally come from our beginning inventory. And since our beginning inventory is sufficient to cover all the units that were sold, then we would know that the cost of these 10,000 units sold will just be the cost of our beginning inventory. So our answer would have simply been 10,000 times 3. Okay, but why is that not the answer? Because again, what method is being used? The average pricing method. So what are you supposed to do? Get the total value of your inventories and divide it by the number of items that will form part of your goods available for sale. So what will form part of your goods available for sale? Your beginning inventory and your purchases. So the total value of your beginning inventory is 30,000. Because it's okay if you will find this insultingly easy, class. That's that is what is our goal, for you to find the most basic questions easy. Okay, there will be a lot of basic questions in the exam and also even in the CMA exam itself. Okay, but we'll have to go through with having to discuss this to make sure that your understanding is correct, so that regardless of what kind of problem will come out, you will arrive at the correct answer. So beginning inventory would be 30,000. The first purchase on January 5 would be for 5,000 units at 4. The total value then of that purchase is 20,000. And then the second purchase on the 15th is also for 5,000 units, but this time at 5 pesos for a total value of 25,000. So how many units are available for sale? 20. How much will be the total value of this 20? It would be 30,000 plus 20,000 plus 25,000 will give you 75,000. How will that help us? By dividing the 75,000 with the total number of units available for sale, we would be able to get our average price per unit. Okay, so how much is the total value of our goods available for sale? 75,000. How many units do we have available for sale? 20,000. 75,000 divided by 20. 20. This is 3.75. So that would be our average price per unit. And what do we do with the average price per unit, class? What do we do with the average price per unit? In solving for our cost of goods sold, simply multiply that with the number of units sold. Okay, so how many units were sold? 10,000. So 10,000 times 3.75, you would get 37,500. Okay, alternative question. If you use last in, first out, how much would have been your cost of goods sold? If you use last in, first out, how much would have been your cost of goods sold? So under last in, first out, what does that mean? The item sold will come from the inventories that are purchased last. Okay, when was the last purchase? On the 15th. How many units were sold? Our purchase 5,000. So will the purchase on the 15th sufficiently cover the entire sales? No. So what do? We move further back. When was the previous when was the previous purchase? On the 5th. Okay, and how many units were sold? Our purchase 5. And that means it is sufficient to cover the rest of the items sold. So basically, if you use first in, first out, the cost of goods sold will come from your purchases from the 15th and the 5th. So if you were asked in the exam, how much would be your cost of goods sold using the last in, first out, your answer would be 45,000. Were you able to get the 45,000? So can this question come out in the exam? Yes. Is it possible for me to just change the method used instead of average pricing, change it to first in, first out? Yes. So again, if it's first in, first out, your answer would be 30,000. Is it possible for me to change it to last in, first out? Yes. And in that case, the answer would be 45,000. Is it possible for this question to come out as is? Yes. And in that case, the answer would be 37,500. Next, Bowman devices values its inventory using first in, first out method. For the current year, the inventory usage exceeds the purchases. Assuming inventory costs are falling and all else is constant, how will this situation affect the income statement for the year? Okay, assuming inventory costs are falling, and then we are using first in, first out. Okay, so your beginning inventory would be higher, while your ending inventory is um, higher. Okay, so if your beginning inventory is lower, that means your tigas is lower, and then if your ending inventory is higher or increasing compared to the beginning inventory, then your cost of goods sold would expectedly be higher. And in this case, uh, the the cost of goods sold would be higher, because our ending inventory is lower. So that means what will happen to your net income if your cost of goods sold is high class? Net income would be lower. So the answer here would be letter B. Next, the company reviewed its inventory values for proper pricing at year end. The company values its inventory using first in, first out. The following summarizes two inventory items examined for the lower of cost or net realizable value. Okay. Because for uh, first takeaway for inventories class, measurement for inventory, very important. It is to be measured at the lower of cost or the net realizable value. What is our acronym for lower of cost or net realizable value? LCNRV. Very important. If you can remember only one thing from inventories, let it be its measurement class, which is that it is to be measured at the lower of its cost or its net realizable value. Okay, so please try to go over the problem and try solving this. I'll give you 25 seconds. What's your answer? A, B, C, or D? Plus, for each inventory item, you are given four kinds of valuation class. Of course, only two will be relevant. The first one would be obviously your original cost. Okay, and then the issue now is what do we compare with the cost? Again, what is the rule? You compare the cost and the net realizable value. So the question now is which of these three will represent the net realizable value? What do you think? Is it the replacement cost? Is it the selling price? Or is it the selling price less disposal costs? Less disposal cost. Okay, the replacement cost is not enough. Okay, if you're talking about replacement cost, uh, it does not take into account the selling cost that may be incurred. The selling price the same. So if you're trying to get the net amount that you'll be able to realize, then definitely it would be the net realizable value. It should be the selling price less selling costs or disposal costs. Okay, the next issue now here is, do we make the comparison item by item or do we make the comparison as to the total? When I say you make the comparison between the cost and the net realizable value. Do we make it item by item or do we get the total? Because if you do it item by item class, for item 1, how much is the cost? 210. Selling price is less disposal cost is 208. Which one is lower? 208. For item number 2, cost is 400. And then uh, net realizable value is 405. So between the 400 and the 405, which one will we use? 400. Between the 210 and the 208, what are we going to use? 208. If we do the comparison item by item. So you would end up adding 208 and 400, which will give you 608. And luckily, that is not among the choices. So what does that tell us? You're going to make the comparison as a total, not on the individual item. But of course, you'll remember, Klasa, in your standard for inventories, you're going to apply the LCNRV test on a per class. Okay, item by item is different from per class. Okay, you do not just compare the cost and the NRV on each item. But of course, if you have different classes of inventories, you are going to apply the measurement rule on a per class basis. But here, it should not be item per item. Okay. But another point of clarification, class, okay, I want you to include in your stock knowledge the measurement of inventories, which is again, it is to be measured at the lower of the cost or the net realizable value. But is it possible the problem will not give you the phrase net realizable value? The answer is yes, which is the case in this problem. But instead, you are given the equivalent of the net realizable value. Okay, basically, the net realizable value is the amount that you would get less everything, less cost of disposal, okay, less your selling cost. So again, do not insist. I know that it's lower of cost in NRV. Why is the problem not giving me the NRV? Look for the equivalent. Okay? So just because you cannot find NRV doesn't mean you do not know how to answer the problem anymore. That will only mean that there must be an equivalent to your net realizable value. And what is the equivalent of your net realizable value in this problem? It is the selling price less the disposal or selling cost. But again, you apply the measurement test on a total basis class. So what are you going to do? Get the total cost of these two inventory items. How much is the total cost of these two class? 210 plus 400, that will give you 610. And then the total of their NRV would be 208 plus 405, that will give you 613. So those are the two amounts that you will have to compare, 613 and 610. Okay, and is it difficult to choose between the two? Which one are you supposed to choose? Choose the lower amount. Is it difficult to determine which one is the lower amount? Because if you will have problems determining which one is lower class, you really have a big problem with class. So the answer here would be letter B, 610,000. Number 26. During the year, the company discovered that the ending inventories reported in its previous 3 years' financial statements were understated as follows. Understated 50 for year one, understated 60 for year two, no understatement on uh, year three. The question now is the company ascertains year-end quantities on a periodic inventory system. The quantities are converted to dollar amounts using the first in, first out cost flow method. Assuming no other accounting errors, the retained earnings of December 31 year 3 would be December 31 year 3. What's your answer here? Letter A, correct. Letter B, understated or overstated by 60. Or letter D, understated by 110. The answer here would be letter A class. By the end of year three, all the errors have already counterbalanced. Okay, so for the year one error class, on year one, the what happened to your on year one, what happened to your what was the scenario here? What is understated? The ending inventory is understated. Let's go to year one first class. For year one, your ending inventory is understated. So what does that have to do? What is its effect on our cost of goods sold? What will happen to your cost of goods sold if your ending inventory is understated? Your cost of goods sold will be overstated. And what will be the effect on your net income? Your net income would be understated. And if your net income is understated, what will happen to your retained earnings? It would be also understated. But that is if we were at year one. Year two, what will happen in year two? Ending inventory is still understated. Ending inventory is still understated. So what will happen? Your cost of goods sold would be overstated by 60, but it will not just be by 60 because what else happened? If in year one your ending inventory was understated, that means for year two, your beginning inventory would also be understated. And what happens to your beginning inventory? It will form part of your cost of goods sold. So basically, there are two errors now on year two because of the 60,000 understatement of the ending inventory, your cost of goods sold would be overstated by 60. But because of the understatement of the beginning inventory, your cost of goods sold should also be understated by 50. So what's the net effect? On year two, the understatement would just be under overstatement would only be 10,000. And if your cost of goods sold is overstated by 10,000, what will happen? Your net income would be understated. If your net income is understated by 10,000, what will be the effect on your retained earnings? Retained earnings would also be understated by 10,000. So by the end of year two, the total understatement in your retained earnings would already be 60. If you remember, in year one, it was understated by 50. In year two, there is an additional understatement of 10. Why only 10? Because part of the error, or the 50,000 error in year one was already corrected by the end of year two. Now, on year three class, the total understatement of your retained earnings of 60,000 after year two will already be corrected by the end of year three. Okay, what will happen on year three? Your beginning inventory would be understated. That means your cost of goods sold would be understated. That means your net income would be overstated by 60. So by year three, the errors in year one and year two are corrected by the end of year three. So the answer would be letter A. So no more overstatement or understatement. But again, if the question is how much is the understatement of your retained earnings on year one, your answer would be uh, 50,000. By the end of year two, what is the understatement in your retained earnings? The answer would be 60,000. But by the end of year three, the errors of the past 2 years are already corrected. Okay? But if the question is on the net income, how much is the understatement of your net income on year one? Your answer would be 50. Next question, how much is the understatement of your net income on year two? It will not be 60, only 10,000. Okay, and then on year three class, how much would be the overstatement of your net income? It would be 60. So there is still an error on year three class. Your net income would still be, will now be overstated. But because of the overstatement in year three, the understatement in year one and year two are already eliminated. So no more errors or no more understatement or misstatement in your retained earnings. But as to your net income, there will still be there will now be an overstatement on year three. So it's very important kasi year one, understatement of net income is 50. Understatement of retained earnings, 50 also. Year two, understatement of net income, only 10,000. I hope you can find the time to analyze it again why it's only 10,000. Because the understatement in the ending inventory in year one will now become an understatement in the beginning inventory of year two. So again, year two understatement of net income only 10,000. But on your retained earnings, the cumulative understatement now in your retained earnings would be an understatement of 60. Year three, how much is the misstatement on your net income on year three? It would be overstatement of 60. So ma-offset na ang year 1 and year 2. Now, misstatement on your retained earnings on year 3, it will now be retained earnings. Year 3 misstatement, it will be 0. Okay, so any of those questions could be asked from this problem. Next, the company misrecording an end of year 10,000 inventory purchase on account in the current year's financial records while finalizing the financial statements after the inventory was located during the year-end count. The company's accountant detected the error and attempted to correct it. Under which the following situations will the company report lower than actual net income? Okay, so please go over the choices and come up with your answer. What's your answer? The answer here should be letter B. The accountant has increased cost of goods sold and increased accounts payable by 10,000. It's correct to increase your accounts payable by 10,000 class, but you should not have increased your cost of goods sold, because what happened to this end of year purchase? Is this already part of your cost of goods sold? The answer is no, this is still on hand. That's why it was detected. During the count, it was determined that this exists, but this was not included in your ending inventory. Okay, so what happened? Your ending inventory is over or understated because you failed to record an end of year purchase. What happened to your ending inventory? Over or understated? Understated. And then, if your ending inventory is understated, what will happen to your cost of goods sold? Your cost of goods sold would be overstated. And what did you do to correct it? In letter B, what did you do to correct it? You increased the cost of goods sold even more. So definitely, you would end up reporting an income that is lower than the correct or actual income. Okay, because hopefully you can analyze the effect on inventories, the effect of inventories on cost of goods sold and net income. Number 28, in a period of rising prices, which of the following inventory valuation methods will most likely have the lowest tax expense? So basically, the one with lowest income. So what's the scenario here? Period of rising prices. So in a period of rising prices, which one will have higher cost of goods sold? Last in, first out, or first in, first out? Which one will have higher cost of goods sold? Period of rising prices, meaning the more recently purchased items are more expensive. Which one will have a higher cost of goods sold? Last in, first out, or first in, first out? Last in, first out. Why? Because the composition of your cost of goods sold under the last in first out will come from the recently purchased inventory, which are priced higher. And if your cost of goods sold is higher, what will it do to your net income? It will make your net income lower. And if your net income is lower, then your tax expense will also be lower. So the answer here would be letter A. Number 29. Which of the following inventory valuation methods cannot be used for IFRS purposes? Okay, we mentioned this already earlier. Which method is not allowed? Your last in, first out. But for some reason, there will be a lot of questions around last in, first out. So the answer here is letter B. Because our first takeaway, what is our first takeaway for today's topic? Is that inventories have to be measured, lower of cost or net realizable value. Remember LC and RV. So it's not in the pre-midterm, but perhaps in your subsequent examination, as part of the essay exam question, you'll be asked how are inventories measured, class you're expected to be able to answer class. Okay, inventories are to be measured at the lower of cost or the net realizable value. It would be very disappointing, class, or you should be disappointed at yourself if you cannot answer how inventories are measured. If you can remember only one thing about inventory, class, let it be its measurement rule, which is the lower of cost or net realizable value. If you can add one more thing to remember, class, if you can add one more thing to remember, let it be that LIFO is not allowed. Okay, and that should not be difficult to include in your stock knowledge class. Number one, LCNRV. Number two, LIFO is not allowed. Okay. Number 30, which of the following inventory cost flow assumptions would require the application of the lower of cost or market or the net realizable value principle? would require the application of the lower of cost or the market principle? The answer here would be LIFO class, because what happens in LIFO, prices are based, your inventories, your ending inventory class. If you use LIFO, what's the source of your ending inventory? It would normally come from the old purchases. Okay, because what happens in LIFO, those that are acquired recently are deemed sold first. So in your ending inventory, where will your ending inventory come from? It will come from the older purchases. And in that case, you would have to check whether the cost at the time of those old purchases is lower than the current prices. So you will really have to check the application of the lower of cost or NRV principle. Now, what's our takeaway for number 28, 29, and 30? If there's LIFO in the choices, that must be the answer. This is what I don't understand. As you will have a lot of questions. No, you will be told that LIFO is not allowed, but you will have a lot of questions surrounding LIFO, and there will even be a lot of questions wherein the answer is LIFO. Hopefully, that would also be the case during the exam. As long as there's LIFO in the choices, that would already be the answer. Class, but that is not the third takeaway, class. Ha? Duhara class, we only have two takeaways so far. Number one, lower of cost on NRV, and number two, LIFO is not allowed. Again, our rule is you cannot commit mistakes on questions you have already encountered. And so far, in the questions we have encountered wherein LIFO is a choice, the answer is LIFO. It's up to you how to use that information. Next, during a period of rising prices, is this still LIFO? No. LIFO. Why would a company choose LIFO inventory cost flow assumption? Uh, if rising prices class, what will happen? Your cost of goods sold would be higher. And what would be the effect if your cost of goods sold is higher? Your net income would be higher. And in that case, lower, sorry. Your net income would be lower. And if your net income is lower, what will happen to your tax expense? Obviously, it will also be lower. Okay, so what's the answer here? Why would the company choose the LIFO inventory cost flow assumption? The answer is to minimize income tax expense. Letter B is definitely wrong. Uh, letter A. What method should be used to achieve letter A? It's not LIFO. Is it FIFO? No. Letter A, you should use specific identification. Okay. Number 32. What is one disadvantage of the perpetual inventory system? Because I think this is one of those questions wherein you can just figure it out from reading the choices. Let's see. Letter A, it provides more control over inventories than a periodic inventory system. Okay. Assuming you don't know whether that's true or not, but again, for the record, this is a true statement. The perpetual inventory system provides you more control over your inventories compared to your periodic inventory system. But assuming you do not know that is true, will you end up choosing this answer? The answer is no, because this is not a disadvantage. This is what I'm talking about. By even just by going over the choices, it's possible for you to get this question right. Letter B, it requires more record keeping than a periodic inventory system. Assuming you don't know whether this is true or not, can this be considered as a disadvantage class? Yes, because it entails more work. Okay, but let's try to go over the other choices. Letter C, companies can keep a detailed daily record of inventory on hand. Is that a disadvantage class? The answer is no. But will there be corresponding disadvantage to letter C? Yes, it can be more expensive. It will require more record keeping. But definitely, this statement alone does not represent a disadvantage. Letter D, companies can determine the cost of goods sold each time a sale occurs. Is that a disadvantage, class? The answer is no. Your records will be more responsive or timely, more updated. So, out of all the choices, even without knowing that the other three choices are true statements, which one would be your, let's say, guess? Assuming you don't know about, which one would be your guess, man? It would be letter B. And there will be questions that are like this, class. Okay, so please take advantage of these kind of questions as well. Okay, you should only get this wrong if you're sleeping, class. So again, the answer here is letter B. I'm not saying sleeping. I'm sleeping the exam, but the only way you will get this wrong if you're not opening your eyes, class. Number 33. The historical cost of the deluxe cat home is $40 and the retail price is 55. The company will spend $4 to sell the deluxe cat home and can replace it for 42. The company wishes to use the lower of cost or net realizable value comparison as a profit margin of 30%. What number should they use for the net realizable value in the analysis? What's your answer, class? Letter, you want to apply the LCNRV, you already have the cost. How much is the cost? 40. So what do you need? You just need the NRV. Is it given? No, you will have to figure out the NRV. Which one, how much then is our NRV? Our NRV is 51. And how do we get the 51? The selling price of 55, the retail price or the selling price of 55 minus the selling cost or disposal cost. How much is the selling cost or the cost to sell? $4. Okay, so 55 minus 4, therefore your NRV would be 51. So you will just be comparing 40 and 51. So possible point of confusion here would be your profit margin. Okay, you do not have to deduct your normal profit margin because you're after the amount that you would get, the net amount that you would get. Okay, and that should include your that should include your uh, that should include your profit. Okay, how much will you get when you sell it? 55. But to sell it, you will have to spend 4. So the net amount that you would get from this transaction would be 51. Okay, maybe you'll get confused, class. Okay, your stock knowledge is so wide. You remembered your you remembered your installment sales, class. What do you do when in your installment sales, class and the customer is unable to pay? You may pursue, starts with letter R, followed by E, letter P, next, repossess. You may choose to repossess the item sold. And what's the main issue in repossession, class? In determining the gain or loss on repossession. And what do you compare to get the gain or loss on repossession? The market, the fair value of the repossessed items, and you compare it with the UC. What does UC stand for? Unrecovered cost. And how do you get the unrecovered cost? You also deduct the profit margin. Okay, that is if you can remember that now. You might get confused with the 30%. So what is my suggestion? Do not remember installment sales anymore. Okay, so just stick to 55 minus 4 and you would get 51. Okay, this should not be difficult, class. If this comes out, I don't know, and you still get this wrong, I don't know. I don't know with you. 34. The company uses a periodic inventory system at year end. At year end, how does the company determine its ending inventory system? So basically, just a theory question on concepts class, on procedure. What do you do when you use periodic inventory system? Take note, under periodic inventory system, you do not keep a detailed or an updated record of the movements in your inventory. So how do you determine your ending inventory? You conduct a physical count. So the answer here is letter A. So basically class in perpetual, you keep a detailed record of your inventories. If there are additions, you update your records. If there are disposals or sales, you you update your records. So by the end of the year, you do not have to do account for you to know how much is left. Okay, all the changes, all the movements in your inventories are all recorded. Okay, so under perpetual, the task is the burden is done throughout the year, but you will no longer need to make account. Under periodic, you will be very chill during the year, but you will have a big task of conducting a physical count at the end of the year. Of course, periodic is still a lot simpler because that's why many would use the periodic inventory system. Number 35. Is this the same question? At year end, the company conducts a physical inventory count to determine, because assuming these two questions will come out in the exam and they come out successively. So even if you're not sure of your answer in number 34, after reading 35 class, you should be able to say, perhaps the answer really in number 34 is letter A. Anyways, at year end, the company conducts a physical count to determine which of the following, that's the question. If this comes out, class, spit on the test paper, class. Are you trying, is the exam trying to insult you? From 34, it says, what do you do to conduct, what do you do to determine ending inventory? Then your answer is letter A. And number 35, it asks you, what are you trying to determine when you conduct a physical count? See down, just to make sure that you are sure. What's your answer, number 35, class? Still, I cannot hear confidence in your answer even. Ending inventory. Plus, your exam would be 100 items, and you will have 3 hours. Uh, even when I was a student class, I normally finish exams early class. But well, no, no, no. But when I took the CMA exam class, I almost consumed the entire 3 hours for the MCQ. I think very no, I think I really ran out of time. No, no, I answered everything, but I wanted to go over those questions I flagged, and I wasn't able to go everything. But I already have answers to everything. I ran out of the 3 hour time limit expired before I was able to go over the uh, all the questions I flagged. Okay, and the main reason, class, is because of second guessing. Ba? There were several questions wherein I flagged it, but my answer would just remain. But I had to spend more time when I answered it the first time, and I even have to spend more time as I reviewed it because of second guessing. And that is my concern, especially during your exam. What if you have this kind of question? It's very obvious at this point that the answer is ending inventory, but you do not have the confidence to choose and move on from that question, to choose ending inventory as the answer and move on from the move on to the other questions without looking back at this problem. If you keep on second guessing class, you will have a hard time finishing all 100 items. So that's why it's important for you to have confidence class so that you can spend your time on questions that will really need your attention. And I think that's a problem common to many students. That is experienced by many students. They have not grown accustomed to choosing the correct answers class. In most cases, they are always unsure. So they would spend a lot of time. If you only but of course you will be able to develop confidence class through practice one. Through the experience of getting questions correctly ba? And that's our goal here, for you to keep on encountering questions, for you to gain confidence on certain topics. So for this one class, you really have to have confidence so that you will move on to the other questions and not waste on a question that you got right and should not have consumed so much of your time. Okay, so again, the answer number 35 should simply be letter D class. Hopefully, you'll be able to develop confidence class. And that's what I'm trying to do nga. Many questions will come from the handouts. Kay, Sharo naman, naa sa handouts class, di kaya po confident nga sakto yung, I don't know, maybe there's a mental hurdle class, but you have to have confidence class. If not now, during the exam, if not during the exam, during the CMA exam. 36. Go over the choices. The company bought 10 tablecloths from Fabric Town for reception plan for one of their clients. When the package arrived, there were 10 red tablecloths included, but no green. If the caterers decide to keep the tablecloths, then so basically a question on how to handle this kind of scenario class. Of course, this is not governed by a standard. This is governed more on uh, customs or practices. So the answer here would be uh, letter C. The supplier may grant, Fabric Town may grant the purchase allowance, which will reduce Joni's caterers accounts payable. So some sort of a discount due to error on the part of the supplier. 37. Let's see if the answer here is LIFO. Companies that want to maximize the asset section of the balance sheet, I think it's not, will use which inventory, uh, during deflationary. So if it's during deflationary class, prices are going down. And what do you want to do? You want your asset sections to look robust, to look uh, appealing. So you want to have a big ending inventory. So when will you have a big ending inventory if prices are going down? If your ending inventory are coming from your old purchases. And when does that happen? When will your ending inventory come from your old purchases? What will happen? When does that happen wherein your ending inventory is from your old purchases, from the previous purchases? If you use last in, first out, because what happens in last in first out? Your cost of goods sold will come from the recent purchases. So your ending inventory will come from your older purchases. And since the prices are going down, which one will be more expensive? The recent purchases or the old purchases? Prices are going down. Which one is more will be priced higher? The recent purchases or the older purchases? Older. And so that means you want your ending inventory to come from the older purchases, and to do that, you will have to use last in, first out. So still undefeated class. If LIFO is in the choices, then LIFO is the answer. Uh, I'm worried that that would be your takeaway from today. Can we skip to 41? Let's see the 41. The company is a luxury car dealership. Which method of inventory costing would they most likely use? Finally, if it's not in bulk class, if it's not mass produced or sold in bulk, if it's uh, highly customized, if it's one of one, then definitely you will not be using first in first. If the items are not interchangeable class, it's not advisable to use first in first out, LIFO, or weighted average. In case of high value items class, you should be using specific identification. But of course, if you read this class, you know for yourself, obviously this is not LIFO. So the answer is always LIFO unless it's very obvious it is not LIFO. So the answer number 41 is letter A. Go back to 38. Which of the following would result in the company's inventory being higher than it should be? You should be able to figure this out, class. Walker miscategorized FOB destination goods in transit to a customer as FOB shipping point. So FOB destination, when do you consider the goods transferred, class? We are the seller in this transaction, FOB destination. When will title transfer? Only upon reaching the destination. So once it is still in transit, it is still owned by the seller. And who are we in this transaction? We are the seller. So that means, but what did we do? Instead of destination point, we recorded it as FOB shipping point, meaning we did not include it in our inventory even though it should have been included. And what's the question here? Inventory being higher, which would result in inventory being higher. So what did we do in letter A? We did not include it even though it should have been included. So what happened to our inventory? Understated or overstated? It was not included even though it should have been included in the seller's inventory. Understated or overstated? Understated. So definitely that is not what is being asked in number 38. Because what's the scenario in number 38? Inventory is higher than it should be, meaning the inventory is overstated. Letter B, the company miscategorized FOB shipping point goods in transit from a supplier as FOB destination. Who are we in this transaction? Buyer or seller? Seller. And it is FOB shipping point. If it's shipping point, the goods should have transferred, the title over the goods should have transferred already to the buyer. So since we are the buyer, this should already be part of our inventory. But what did we do? We categorize it as FOB destination. So what does that mean? We did not include it in our inventory yet. Should it have been included? Yes. Did we include it? No. So what would be the effect on our inventory? Under or overstated? Understated. So still not what is being asked. Letter C. Consignment goods in transit from a supplier as FOB destination. So who are we in this transaction? Are we the consignor or the consignee? Consignee. And uh, are we supposed to include consigned goods if we are the consignee? The answer is no. And we did not even include it also. Okay, so does not matter. So no misstatement. Still not the answer. So the answer here must be letter D. Categorize FOB shipping go. I always join point and goods. FOB shipping point goods in transit to a customer as FOB destination. Who are we in this transaction? Seller or buyer? Seller. Okay, goods in transit to a customer. So we are the seller. And it is FOB shipping point. So when does title transfer? At the point of shipping. And was it already shipped? Yes, because it is already in transit. So, should it be part of our inventory? No. But what did we do? We still included it in our inventory because we categorized it as FOB destination. So what then is the effect on our inventory? Our inventory would be overstated. So the answer here would be letter delta delta. Let's make sure to analyze number 39. I'm already at 2%. 39, the answer here would be assets are overstated and net income is overstated. The answer would be letter C. Number 40, which of the following would change as a result of changing inventory cost flow assumption? The answer here would be letter A, gross profit on sales, because there will be a change in your cost of goods sold. Selling price not affected, amount of sales not affected. Of course, your sales discount, which is also based on selling price, will also not be affected. 41 already answered. Number 42, ownership to goods shipped FOB destination is passed to the buyer, of course, when the goods are when the goods arrive at the destination one, arrive at the buyer's business. 43, the answer here would be, please solve this, Kasa. The answer here would be 86,250. Letter D, 86,250, 1%. Although the perpetual inventory system is used by most businesses, a year-end blank is taken to reconcile actual